Get Rich Education is brought to you by Valhalla Wealth and Ridge Lending Group.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE, Get Rich Education, episode 166. I'm your host, Keith Weinhold, and we're going to be talking with Dad Advisor Tom Wheelwright shortly about the most sweeping tax changes in decades, including changes to real estate tax depreciation, changes to the 1031 Tax-Deferred Exchange, who the winners are going to be, who the losers are going to be, and a lot more. And the good news is that the benefits are mostly going up for investors, including real estate investors. And I expect to do some learning along with you today myself, as I often do when Tom Wheelwright's here. But first, what's going on with housing prices now that we're here near the end of the year? Well, through the latest month ended, all of the top 20 cities, every one of the 20 in the Case-Shiller Housing Price Index have seen year-over-year increases. And of course, the Case-Shiller 20 is truly an imperfect index, and it doesn't include some of the cash flowing markets that are best, but it is a barometer with some meaning to us here. And over the last 12 months, home prices increased 6.2%. So 6.2%, not much different really than the historic normal appreciation rate of real estate. And see, it's still underscored by some pretty conservative, responsible lending practices that are prevailing out there. So I just love it when it's like this. It's not too hot. It's not too cold, although it might be pretty hot on the coast with appreciation. And, you know, the borrowers getting the loans, they're going to be pretty likely to make their payments. So therefore, if you're leveraged 4-to-1 on your portfolio, that's right. You've got a 24.8% annual appreciation rate in your portfolio, which, as I like to say, is, of course, one of only 5 simultaneous profit centers that you expect as a leveraged income property investor. That's something to celebrate. The chairman of the index committee at Case-Shiller there, he says that, quote, most economic indicators suggest that home prices can see further gains in the future there. So take that for what it's worth. I put the link to that article in the show notes for you. It's got a chart with it in case you want to see the details and the seasonal adjustment factors and such, but that's pretty much the upshot right there. Hey, before we get to Tom Wheelwright, as you're out there building your real estate investing portfolio, I want to talk to you about diversification. Thinking about diversifying your real estate investing portfolio geographically, yeah, okay, geography is important for sure, but keep in mind that it's not just about geography. It also might be about the economic strata of your tenant. You know how I always tell you, you want to think about how your tenant is thinking and meet their needs and their concerns. And that's the way that you can not only do good in the world, but you can be a profiteer. So thinking about the economic strata of your tenants, let's say you've bought turnkey real estate, like you've got some income property in Memphis, Birmingham, Jacksonville, Dallas, and then finally you've also bought, say, coffee farm parcels in Panama or some other kind of agricultural property. Well, besides just geographic diversification, now consider that maybe you've targeted a Mid-South home buyers in Memphis because that tenant demographic is squarely below middle class. And maybe you're in Birmingham because that might be just a rung up socioeconomically. And then you've bought in Dallas or Jacksonville, as there it's often newer construction homes, more or less. So there you might be catering to a demographic that's above middle class. And then finally, if you own individually titled teak wood or coffee farm parcels in Latin America, well, now you're catering to a high-end end consumer with those. Then, besides diversifying among different socioeconomic statuses like those there and within different geographies, you might also want to diversify among cash flowing markets like St. Louis and Memphis, and then markets where you expect more appreciation like a Dallas. I kind of call that performance diversification in addition to geographic and socioeconomic diversification. So really 3 different types of diversification there. So just be mindful that there are different ways for you to conceive of and act upon diversification. And really the bottom line is you want your cash flow streams to be durable. And when you think of it holistically that way, and your overall total rate of return then is more likely to be durable. And by the way, you can find out about all those providers that I mentioned and more at greturnkey.com. And a couple of the newest things, the latest highlights on greturnkey.com is that Jacksonville, Florida has brand new construction turnkey properties that you can get into. Rents on those are commonly $1,500, and the purchase prices are $180 to $190K, so they're not hitting that 1% rent-to-value ratio, and many places aren't these days. But when you've got new construction in a place like Jacksonville, just think about how tenants usually want to stay in those longer when they're the first people that have ever lived in a home, and also how you're going to be likely to have lower repair and maintenance costs with new construction. Not always, but it just tends to be that way. And there is available inventory right now in Jacksonville. New construction available now. There's also inventory available right now in Orlando. That's our latest market added to greturnkey.com. And they actually, as of today, yes, they do have some available inventory. And that's actually newsworthy here that turnkey inventory is available because waiting lists elsewhere are fairly common. So again, at greturnkey.com, that's both the Jacksonville section and the Orlando section there. Well, Rich Dad Advisor Tom Wheelwright, whom is the sharpest tax mind I've ever known, is here once again. He's going to tell us that tax benefits, yes, they are going up for investors. You're going to love hearing about that. First, I think he's going to give us that quick overview on what's going to happen with the corporate tax rate, and then mostly talk to us as real estate investors. We are now looking at the most sweeping tax changes in decades, perhaps the biggest changes in your entire life, depending on your age. We're looking at changes to the long-time standard 27.5-year depreciation on residential property. We're looking at changes to 1031 tax-deferred exchanges too. And whether you like Trump or not, this is just kind of what happens when you have a real estate and a pro-business president and administration. Now, Tom Wheelwright, he has painstakingly read both the House and the Senate bill on the sweeping tax changes. Those bills are 500 pages each. And by the way, that's not painstaking to Tom. It's what he loves to do, and he's just going to distill it all down for us in one concise segment. As far as what this means to you and what you can do about it is really what we're going to get to. Hang on. It promises to be a fast, action-packed ride. We're coming back with Rich Dad Advisor Tom Wheelwright. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president and chief wealth strategist of Valhalla Wealth. They help busy people build wealth outside of Wall Street by strategically combining their clients' cash flow statements with the financial vehicle of the wealthy, according to the infinite banking concept. If you are interested to learn how to perpetually multiply your wealth, you can access an exclusive webinar at yourownbankingsystem.com. Cash flow real estate investors, if you're looking for a mortgage loan with a company that specializes in investment property loans, it's Ridge Lending Group. They provide income property loans in almost every U.S. state. Ridge has worked with tens of thousands of investors and homeowners all over the country. In fact, with ethics and transparency, they've helped more people realize their dreams through real estate investing than any other mortgage lender in the country. Get started at ridgelendinggroup.com.
This is Rich Dad Advisor Darren Weeks. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Today, we have a tax expert on the show. You likely already know who he is because he's been a regular contributor here at Get Rich Education. He's the founder and visionary of ProVision, based in Tempe, Arizona, the top tax planning firm that I know of anywhere, frankly. His firm handles the taxes for Robert Kiyosaki and, well, for me and my family, among other clients. And he and I are each contributing writers at the Rich Dad Advisors blog. We write articles alongside each other there at richdadadvisors.com. He's the best-selling author of the book Tax-Free Wealth, which is the only tax book I've ever been able to read cover to cover because although he covers taxes, he really keeps your attention. This year, he authored the book More Important Than Money, along with Robert Kiyosaki and the Rich Dad Advisors. He's also the creator of these great newly done video modules called Tax-Free Wealth Formula, so he's just all over the place. He's been contributing to us and others for a long time. Welcome back to Get Rich Education, Rich Dad Advisor Tom Wheelwright.
Hey, thanks, Keith. Always good to be on Get Rich Education. Love the show and love your audience.
It's an interesting time to be you because Trump tax reform can go ahead and affect so many people in the United States, and it can affect them in different ways, both on the business level and on the personal level, Tom. So let's just talk here. You know, we've been holding off on this episode a little bit because I kind of want to see what happens, and I don't want this to be a speculative episode. Why don't we talk about the things that are most likely to impact people as both homeowners and as real estate investors with Trump tax reform?
We can actually talk about what's going to happen. I can tell you with 99% predictability as to what will and what won't happen. There are a few things that we don't know. We really do. For those of us who study this and have watched tax legislation over the years, we have a really, really good idea of what's going to happen. And I've actually been predicting it for a year and a half, that what the tax reform we were going to get was going to be corporate tax reform. It is not personal tax reform. This is not a personal tax reform bill. I want to be really clear. It is a business tax reform bill, and it's really the only real tax reform in it is corporate tax reform. You know, if you look at the two bills, House and the Senate, what is common, which, by the way, what's common is what's going to pass, right? What's common between the two bills is a lot of individual tax benefits go away, and a lot of business tax benefits are increased. And this is a business tax bill, and there's no two ways to look at it. The House bill is actually quite different from the Senate bill in that it is more policy-oriented. It does the business tax reform, and it really takes away a lot of individual tax benefits. When you look at the tax bill, really look at those things that are in common. So what are they? We're going to have a corporate tax rate of 20%. Whether it goes this year or next year, it'll be 20%. That's what's in the House. That's what the Senate bill. That's what the corporate tax rate is going to be, 20%.
Which is a substantial break.
It's a huge break because when you consider the corporate tax rate, you know, technically it's 35%. It's a flat 35%. Once you get over a hump, it's a flat 35% plus state taxes. So now you're going from 35 to 20. That's a pretty substantial break. That's like a 45% tax break, right, for corporations. Well, you also you can't leave out the small businesses because they're a big part of the vote, particularly the big part of the vote for the Republicans are small businesses. So they're going, okay, we're going to have to do something for small businesses, which is the flow through. And so the Senate and the House have taken completely different approaches to it. The House has said we're going to give a maximum rate of 25%, which of course hurts the really small business because they're not in the 25% bracket anyway. And then you have the Senate that says, well, we're just going to give them a 17.4% deduction, which actually I think will end up being 20%. If you look at it, though, I've actually run the numbers. What the House and the Senate are really trying to do is bring corporations and flow-throughs to the same tax level. Because if you think about it, flow-throughs have always been less expensive because you only get taxed once. And so even though you have a 39.6% tax rate, and maybe even up to 42% because of the Obamacare tax. Let's say you've got a 39.6%. Well, that's still cheaper than a 35% tax rate at the corporate level plus a 15 to 20% tax rate when you pay out the dividends, right? So it's still cheaper. But now what they've done is they've actually given them parity. So no longer will it be a major benefit to be a flow-through. Actually, what's going to happen is you're going to have to pay a lot more attention to, are you a flow-through like an S-corp or a partnership? And, you know, if you're a real estate investor, typically you're a partnership. If you're fixing and flipping, typically you're going to be an S-corporation because you're trying to avoid the Social Security taxes, right? Self-employment tax. But that's a pretty easy decision, isn't it? You're never going to say, I'm going to be a C-corp. Nobody's ever saying that. But now you're going to have to bring that into play. So you're going to have to start thinking, am I an S-corp? Am I a partnership? Or am I C-corp? And so your strategy actually becomes, this is not a tax simplification bill, folks. Your strategy actually becomes more complex. So we're always talking on the show about advisors and building a team and so forth. Now it's going to be more important because you're not going to be able to say, I mean, you can if you say, well, I don't really care. I'm getting a tax break. As a small business, I am getting a tax break under any of the bills. So why do we even care? Well, because you can get an even bigger tax break. It's a matter of, do you really want to pay what you're paying or do you want to pay less? And that's really what tax strategy is about. The law is there for you. And now, speaking of tax breaks, Keith, you got to be ecstatic as a real estate investor of this new bill because this new bill does huge things for real estate. Depreciation on commercial goes from 39 years to 25 years.
So that will be an even shorter time period than it is for residential.
No, it'll be exactly the same. They're going to be both 25. So they're making them the same. Commercial and residential are going to be the same. It never made any sense to have them be different in the first place. It was just a matter of where's the money coming from.
Okay, so they're changing them both.
So now they've changed them both. So residential was 27.5. It's going to be 25. I think that's going to be the end result. Another thing that changes, which doesn't change for real estate, but it's only real estate doesn't change, and that is the like-kind exchange or 1031. We've talked about 1031 exchanges on the show before, Keith, and I think most real estate investors have a general idea that, look, if I sell my real estate, then I can buy another piece of real estate, equal or up, and I don't have to pay tax until eventually I do cash out. And frankly, I don't know why you'd ever cash out. You just die, and then the tax goes away.
Right.
So under the new bills, what's really interesting is 1031s, which used to apply to personal property as well as real property. If you trade in a car, a business car, you don't have to pay tax on it if you do a trade-in. Okay, that's a like-kind exchange. That's why you don't have to pay tax when you trade in your car. It used to apply to cattle. You could exchange one steer for another steer. You just can't exchange a bull for a cow because they're not like-kind. But that's going away. So they're eliminating like-kind exchanges for personal property under this bill, which is, means that real estate, again, comes out unscathed. The other thing that happens with real estate that I thought was shocking was that they didn't undo the carried interest for real estate. So carried interest, for those of you who don't know, if you're a developer, this is where it applies, and instead of just taking fees, you take an ownership interest in the property, and so basically you get paid some percentage of when you sell or refinance, okay? That's a carried interest. And historically, that's always been capital gain because it's selling the property. So selling property creates capital gain. You have an interest in that gain, which is different than an interest in, say, management fees or rents or something like that. So that's always been a big deal for real estate. Trump, Clinton, Obama has been after the carried interest rule because the hedge funds have been using it. And it was originally intended for real estate, and the hedge funds have been using it. So here's what they did. In the bill, they're just changing the holding period from 1 year to 3. For most real estate people, that's fine because it takes 3 years to lease up a property and get it ready for sale. I mean, yeah, in a hot market like Austin, Texas right now, developers are flipping in a year and a half. But that's a really unusual situation. Typically, it's going to be 3 to 5 years before you ever sell that property. So it's not hurting real estate, but it's going to hurt the hedge funds because they like to flip, right? And they like to flip after a year. So they left that in. And I think that is really good for the real estate industry because you're going to still get that carried interest, which is a huge tax benefit because basically you're reducing your tax by 50% by changing it from ordinary income, converting it from ordinary income to capital gain.
Right. Ordinary income being at basically the highest tax rate that you're going to pay, and then capital gain being 15 to 20%.
Right. We will get individual tax rate changes. We don't know what they'll be because they're very different in the House and Senate. We will get individual tax rate changes. Where individuals really get hurt, though, is like people who live on the coasts. It's the wage earners that get hurt. You live on the coast. Let's say you've got itemized deductions. I actually did a webinar last night, and we had a caller who said that they had about $39,000 of itemized deductions, and they have one child. They are going to have a tax increase. They're going to have a tax increase because they're still going to be itemizing, but they're going to lose their state tax deduction. So they're not getting the full 39 anymore. Now they're probably down to 29, and they're losing their personal exemptions, which is about 13 grand. So they're losing 22, 23 grand of deductions. And what do they get in return? They get $900 of tax credit. So it's not a good trade for them. And so a lot of people will be paying higher tax.
Okay, so we're talking about the inability for one to go ahead and write off their state income tax. And oftentimes state income taxes are higher on the coast and they're higher where we have these higher real estate value markets.
Right.
So therefore, those people are going to be impacted the most.
Plus, the other people are impacted, of course, that are paying a lot more for their home mortgage because that's being limited to $500,000. It's $500 in the House. It's $1 million in the Senate. I think it'll be $500 because they've really got to raise the revenue. If you look at two bills and you say, which one produced the most revenue, you're going to pick that one that produced the most revenue because you know they're looking for revenue. So I think you're going to have some limitation on home mortgage interest deduction, which also affects the people on the coast. So let's be honest about this. This is Donald Trump saying, you guys on the coast didn't vote for me. You don't like me. So heck with you. We're going to increase your taxes.
That's right. I hadn't thought of it that way. Now, if those tax deductions are being taken away for people in higher price markets, is that actually a constraint on home value appreciation? Because it's going to be more difficult for people to afford to buy new like homes.
For sure. It'll slow it down a little. I don't think it'll put the brakes on it, but I think it will slow it down. Absolutely will slow down appreciation, which frankly, those markets need to slow down a little bit because they tend to kind of go a little too fast. It's not sustainable. I mean, when you look at California home prices or you look at New Jersey, New York home prices, and you go, who pays this? How can you possibly afford this? So I actually think it's not necessarily a bad thing to put a little negative pressure on the market growth.
Yeah, I see it the same way. It's sort of a small impediment to new buyers for those more expensive properties. Anything else with winners and losers with this Trump tax reform, especially when it comes to homeowners and real estate investors?
If you're an employee and you invest in the stock market, you're losing, okay? Unless you're under a certain threshold. But if you're kind of what I call middle income or higher middle income, these are the two categories that are probably losing a little ground under the tax bill. This is really an incentive. What they're saying is, look, if you invest in the stock market through a 401k, mutual fund, IRA, et cetera, we're not going to give you any benefits except for a little bit of a rate reduction, right? And this standard deduction is going to go higher. So if you're not itemizing or if you itemize less than $24,000, then it's good for you. On the other hand, if you invest in real estate, we're going to give you all sorts of better tax benefits. So the benefits are actually going up for investors and going down for non-investors. They're going up for people who actively invest, say real estate, business, commodities, farming, agriculture, because they're active investments.
Yeah.
And they're not changing. It's not that they're going down, it's that they're just not changing your standard stock market 401k investor.
I just want to circle back to something, Tom, about the 1031 Tax-Deferred Exchange. Give us some more details about what we expect there for the future, because this is a really important long-term thing toward going ahead and increasing our velocity of money and leveraging more property over the long term, a tool that I've used and discussed quite a bit on my show. Tell us more.
Well, as you would expect, given the industry our president lives in, yeah. It's getting a pass on this. I mean, the 1031 exchange is an unusual worldwide. It's a very unusual provision. In fact, I have not found another country. Doesn't mean there isn't one. I have not found another country that does a 1031 exchange.
Oh, absolutely. Yeah, and it's substantial. We recently had Dad Advisor Darren Weeks on.
Right.
He's a Canada-based investor, and he told us he still owns his first property from 1990, largely because there's no tax-deferred exchange vehicle there, for example.
Right. Now, they have cost segregations, which you've also talked about, and most countries do have cost segregation, so you can accelerate your depreciation, but you can't do that exchange. Now, here's the other thing that's really interesting in this bill that I think our listeners here will really like, and that is the estate tax. So in the Senate bill, the estate tax doesn't go away. It just goes up. They double the exclusion or the exemption amount, and then that's pretty much what happens. Then eventually it's supposed to go away, but it's never going to go. In the House, it's supposed to go away after a number of years. It's never going to go away, okay? It makes no sense for it to go away. I have a tough time arguing that it should go away. It's just hard to believe it's going to go away. But here's the great thing. Whether it goes away or not, we still get the step up in basis. Now, this is the key to 1031 exchange because it's exchange until you die, right? Because you can always borrow against your property. So you can always get the cash out of your property. You don't have to sell it to get the cash out. In fact, I know that Ken McElroy and I, we did a little analysis of one of his properties a while back, a couple of years ago, and because he called me up. He goes, should I sell or should I refinance? And we ran the numbers, and he actually pulled out more cash refinancing than if he sold.
I have not had that happen in my own personal life before. It's always been the other way around.
Right, but here's why. Because if you sell, it's fine if you're going to do a 1031 exchange. But if you sell and have to pay the tax, sometimes that tax is higher than the 25% equity that you have to maintain. So your tax could actually be higher than that equity that you have to maintain in the property when you're borrowing against it. So if you've got several investors, it's hard to do a 1031 exchange, right? Because you got to get everybody to agree. So if you're just doing your own investing and, you may have a couple of family members investing with you, no problem doing 1031 exchange. But when you have 40 investors, 50 investors like Kenny does, then it's going to be tough doing the 1031 exchange. He just found that it's actually cheaper to refinance the property. So you can get cash out, okay? I don't think cash for the most part should be the issue, because if I can take cash out without paying tax, typically, even if it's not quite as good, it's got to be pretty close, okay, if I'm not paying the tax. So I exchange. So I keep exchanging my whole life. And I go from different types of property. I might start with single-family homes. I go to apartment buildings. I end up in a triple net lease with Walgreens or Walmart or somebody like that. I mean, I can do all sorts of different types of properties because real estate is real estate from a tax standpoint. So then when I die, what happens? Let's say that I've depreciated down, and let's say I've got $5 million. Let's say now I got $10 million. I got $10 million of real estate, but my basis is like $300,000. So if I sold that property, I'd have this huge amount of capital gains tax. However, what the bills both do, even if they get rid of the estate tax, is they allow you to continue to step up your basis. So what that means is you got this property, it's $10 million. $300,000 basis, which means you've got $9.7 million of capital gain sitting in there. Then what happens? You die. Now your basis is $10 million. You have no capital gain, and because of the increase in the exemption amount, you probably have no estate tax. The estate tax exemption is going up to, right off the bat, $22 million for a couple, married couple, $11 million for a single person. It's doubling. Eventually, it's supposed to go away, but here's the thing. Even in the bills that actually have it going away, you still get step up in basis. So, we talked about we've got to change in how we have to think about our tax strategy under these bills, our income tax strategy. We also have to have a very completely different way of looking at our estate planning strategy. So anybody who's done any kind of estate planning, or if you haven't, you're going to have to revisit that. You've done any kind of tax planning or you haven't, you've got to revisit that, because really there is a shift in the world. It's still series of incentives. That's the tax law. That's the premise of tax-free wealth. It's a series of incentives. It's just those incentives are changing somewhat. So you have to re-examine what those incentives are and how to best take advantage of them.
Sure, and those incentives are essentially what introduces the complication to the tax code. Well, Tom, these are some substantial changes that you're talking about, changes to the estate tax, changes to the corporate tax rate, and so on. How many years has it been since we will have had tax change this significant? I just want to give our listeners some idea of the gravity of how substantial these changes are.
Last time we had tax change this big was 1986. I was in Washington, D.C., and that was the Reagan Tax Act, Tax Reform Act of 1986. Interesting, that what started out being the Tax Simplification Act of 1985. They couldn't make it simpler, so they called it the Tax Reform Act of 1986.
We knew that name couldn't stick.
Yeah, there's no way that was going to stick. And, of course, that's where we got the passive loss rules, which have been, the bane of the real estate investor crowd for, all these years since then. There's actually one other change that people might be interested in, and that is that you're going to have a limitation on how much of your losses you can use against your regular income. So even if you're a real estate professional, you may not be able to offset all of your regular income with losses from your real estate, even if you are qualified as a real estate professional. So that's something to look out for. There's a lot of other things in these bills to look out for. Let me tell you, if I were a taxpayer, I would be sent down with my CPA now and over the next few weeks and really looking at how do I deal with these changes.
Yeah, because we're talking at an interesting time here near the end of the year. What's the best way for someone to connect with you to get up to date on those changes and how a listener can be helped?
Absolutely best way, go to taxfreewealthadvisor.com. Get on our free report, because our weekly report, we are updating you on the tax bill and the tax situation every single week. And that free report goes out week after week after week, no exception. We never have an interruption on that. It's purely educational. There's never any sales in it. So that's what I would do. Go to taxfreewealthadvisor.com and sign up for a free report. If you want to come talk to us, you can call us at 866-467-5809. 866-467-5809.
The fastest way to increase your effective ROI is to get educated on taxes and cut that expense. Taxfreewealthadvisor.com. Tom Wheelwright, thanks so much for coming back onto the show.
Thank you very much, Keith.
Well, a lot of great takeaways for you there. So much great nutrient-dense material, once again, from Tom Wheelwright. It's the type of thing you'll probably want to listen to more than once. That was nutrient-dense like goji berries, or perhaps nutrient-dense like raw kale. But listening to Tom is a lot easier than eating raw kale. Tom really brings energy to taxes. Gosh, those that live on the coasts get hurt the most again. Now, I want to make some of this easier to digest for you, especially if you're a newer real estate investor. Some of that material might have gone over your head. So I want to break some of that down for you nice and slowly here, okay? I'll just break down the tax depreciation portion for you before we say bye for the week here. With tax depreciation and the changes expected to occur, let's just say you purchase an income property, and all this, by the way, only applies to income property. Say you buy a property for $130,000. That's a nice number, since that might be about the average cost of a turnkey property that you'll find at greturnkey.com, something like that value. Your $130,000 property, now that might have a value of $30,000 for the land portion, and you can't depreciate that land because land doesn't wear out. So of this $130,000, you can only tax depreciate what's called the improved portion, pretty much just the structure itself, and its value alone is then $100,000. Currently, since this is residential property, you take that $100,000 structure value and divide it by 27 and a half years, and you get about $3,600 per year. Okay, that's $3,600 per year for you that you don't have to pay tax on. So if your annual rental income on this property is $10,000, now your tax obligation is only $10,000 minus the $3,600 write-off. Yeah, that's right. So that's just $6,400 that's taxable to you, not the full $10,000. So $3,600 is generally exempt from you having to pay tax on it due to tax depreciation. However, Tom is telling us that it is expecting to get a little better for real estate investors because the 27.5-year residential depreciation schedule is shortening to 25 years. So then it's expected that you've still got this, say, $130,000 property, of which $100,000 of it is the improved portion, and that's what can be depreciated. That's now going to be divided by 25, not 27.5. So therefore, each year you'll be able to take the $100,000, divide it by just 25, and you'll have a $4,000 write-off. So therefore, with your same $10,000 of rental income on your property, only $6,000 of it will be taxable, not $6,400 taxable like it currently is. So in the future, since you've now got $4,000 of rent income sheltered from taxes, and just say you're in the 25% marginal income tax bracket, you will save $1,000 per year on your taxes just from this one property. So even though your property typically appreciates in value over time, not depreciates, the government is giving you this generous tax break because they're just saying that that rental home is just going to slowly wear out over time. So even though you didn't have to spend any money out of pocket, you still get a tax write-off. That's why Tom calls it the magic of depreciation in his book. So that is how it is of a small but a greater advantage to us to have the 27.5-year residential income property tax depreciation be shortened down to just 25 years. Theoretically, the entire improved property can now be written off over a shorter time horizon. After 25 years, if you held that property all that time, your income property tax depreciation benefit will be gone after those 25 years. So I just wanted to slow it down and simplify it for you here, as I often like to do for you. There are some more details and caveats to tax depreciation than this, but that's really the big picture. I am not a tax advisor. Tom Wheelwright is. I think you know, after listening to me for years, that taxes and asset protection are probably two areas where my knowledge base is thinner, so I rely on rich side advisors Tom Wheelwright and Garrett Sutton in those two areas. I'm probably better known for some other areas of expertise like ROI calculation, equity management, maybe market selection, abundance mindset, and some other things like that. So I hope that further breakdown helped you understand your taxes better. Now imagine if someone broke it down for you like that and it was tailored right to your own situation. Well, Tom's expertise can do that for you. And again, his website is taxfreewealthadvisor.com. Of course, a resource like that is in the show notes for you. Taxes will be your greatest expense in life. Learn what you can about them, strategize accordingly, and it's going to be like an instant ROI for you without you even having to add more properties to your portfolio. As always, I am just truly, completely honored that you're here, and in exchange, I want to provide more value to you than the value of your time that you spent listening. I am Keith Weinhold, and I will be back next week to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.